Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Closing price for Voyager Technologies, ticker VOYG, for Wednesday, February 11th, 2026, $26.31. That's down 3.59% on the day. Volume was light, coming in at just 1.08 million shares. This puts the stock in a consolidation pattern. We are looking at an equity that has whipped through a massive 52-week range. I mean, from a low of $17.41 to a high of nearly $74. Just look at the last week. It's been a violent tug of war. We saw an 11% surge on February 6th, catalyzed by CEO Dylan Taylor's comments on space data centers, followed almost immediately by a 12% drop on February 5th after the exclusion from the U.S. Army's Flight School Next Phase 3 selection. The market is, well, it's frantically trying to find a floor here.
And that frantic behavior is exactly why we need to pause and strip away the narrative. The central tension here is, well, it's undeniable. Is Voyager a high beta speculative tech play, meaning it's just surfing the waves of market hype and press releases? Or is it, as the bulls have been claiming since the IPO, a misunderstood industrial prime contractor that is quietly building a monopoly-like gateway to orbit? Because right now, the market is pricing in a lot of confusion.
I think the confusion comes from looking at the rearview mirror rather than the windshield. My thesis is clear. Voyager is not just another space stock. It is a vertically integrated infrastructure play. We are looking at a company with a fortress balance sheet, $413 million in cash, that is effectively positioning itself to replace the International Space Station. We aren't looking at a speculative trade. We're looking at a potential 5-fold valuation increase as they operationalize Starlab.
I see the cash, sure, but I also see a valley of death between now and 2030. For the listeners, that's the gap where research grants dry up, but commercial revenue hasn't started yet. They are heavily reliant on government whims. They are betting on unproven physics regarding, well, space cooling, and their valuation just ignores the massive execution risks of the Starlab project. You see a fortress, I see a company burning cash in a vacuum, waiting for a rocket that hasn't even launched yet.
It's not a venture capital science project anymore. Voyager has successfully transitioned from venture to industrial infrastructure, and the numbers, they really back that up. You mentioned the cash burn, but let's look at the liquidity. As of late 2025, they reported $413.3 million in cash and equivalents. Total liquidity is over $613 million. But the number that really matters here, the one that Wall Street is ignoring, is the debt-to-equity ratio, 0.02.
Okay, 0.02. That is admittedly low.
It's effectively zero leverage. In a high-interest rate environment like we have in 2026, for a growth company building hardware, that is just unheard of. It provides a safety net that their competitors, most of whom are drowning in debt service payments or constantly diluting shareholders just to keep the lights on, they simply do not have.
Cash is great, don't get me wrong, but cash burns remarkably fast when you're building a space station. $400 million is a lot of money to you and me, but in aerospace, that's 2 bad quarters and 1 delayed launch.
It would be if they weren't generating revenue now. Look at the mission management heritage. On February 9th, just 3 days ago, Voyager secured a $24.5 million contract from NASA's Johnson Space Center. This is an IDIQ contract, indefinite delivery, indefinite quantity.
Which is basically a pre-approved shopping list for NASA.
Exactly. It covers ISS mission management services right through 2030.
But it's $24 million. In the context of an aerospace prime contractor, that's a rounding error that barely keeps the coffee machines running at headquarters.
It's not about the revenue line item, it's about the interface. This contract establishes Voyager as the primary interface for payload integration and safety compliance for the next 4 years. They are writing the rulebook for how things get onto a station. And that brings me to the core of the bull case, the intellectual property moat. On February 11th, the company was awarded its 6th patent related to the Bishop airlock. This covers the proprietary electrical power and data interface architecture. I mean, think about what that means. The Bishop airlock is effectively the universal adapter for the ISS. By patenting that interface, Voyager ensures that any future commercial station using common berthing mechanisms, the standard industry docking port, will likely have to pay Voyager a toll to plug in. They own the USB port of low Earth orbit.
I'm sorry, but I just don't buy that the Bishop airlock is enough to justify a multi-billion-dollar valuation. You're talking about a universal adapter for a market that barely exists yet. It's like owning the patent on a specific type of saddle before anyone has tamed a horse. Let me tell you why I look at this and see systemic risk. You're banking on a valuation that assumes a perfect execution of the Starlab launch in 2029. In the aerospace industry, perfect execution is a myth. Look at the design. Starlab is designed for a single launch deployment on SpaceX's Starship. That is a single point of failure.
It's also their biggest differentiator.
It's a binary risk. If Starship is delayed, and let's be honest, heavy-lift rockets are always delayed, the entire revenue timeline for Voyager collapses. There is no Plan B launch vehicle for a station that size. It's too big for a Vulcan, too big for a New Glenn. If Starship catches a cold, Voyager gets pneumonia.
Starship is progressing rapidly, though. We've seen the test flights.
Progressing is not operational, and while they wait, look at their revenue mix. 84% of their revenue comes from the U.S. government. That is a massive concentration risk. And we just saw the downside of that on February 5th. They lost the Army Flight School Next Phase 3 contract to Bell and Lockheed Martin.
That was a terrestrial contract.
Exactly. It proves that when they step out of their niche and try to compete with the legacy primes, the Lockheeds and Boeings on their home turf, they lose. They don't have the lobbying power or the scale yet. And frankly, I'm skeptical about the rally we saw on the 6th regarding space data centers. CEO Dylan Taylor goes out and talks about solving terrestrial cooling by putting data centers in space. It sounded great. The stock popped 11%. But we need to talk about the physics of that later, because simply putting a server in orbit doesn't solve the heat problem. It actually makes it harder.
That's a fair critique of the physics, and we will dig into that. But I want to step back to your point about Starlab and the competition. You mentioned the risk of the single launch on Starship. I see that as their greatest strategic advantage. Let's look at the Starlab strategy versus the competitive landscape. You have competitors like Blue Origin with Orbital Reef, or Vast with Haven One. They are building modular stations. They have to launch piece by piece, docking module A to module B, connecting wires, hoping the seals hold. I mean, that is slow, it is expensive, and it is prone to error. It's exactly how the ISS was built, and it took decades. Voyager is taking the joint venture model. Starlab isn't going it alone. They have Airbus representing Europe, Mitsubishi Corporation for Japan, and MDA Space for Canada. These are equity partners, not just vendors.
But partnerships don't launch rockets. You can have the best Rolodex in the world, but if the hardware isn't in orbit, it's worth zero.
No, but they pre-sell the destination. Think about the geopolitics. Sovereign nations like the members of ESA, the European Space Agency, and JAXA in Japan, they need a home for their astronauts post-ISS. Do you think they're going to send their astronauts to a station owned entirely by Jeff Bezos? Or are they going to send them to the station that they partially own? Mitsubishi Corporation just recently committed to pre-purchase payload capacity on Starlab. That validates the demand. They are effectively locking in the customer base before the metal is even cut. It's a sovereign lock-in.
That sounds nice in a boardroom, but let's look at the hardware reality. You dismiss modularity, but look at the timeline. Vast is launching Haven 1 in 2027. That is 2 years before Starlab even hopes to launch. Axiom Space is already attached to the ISS. Axiom has a first-mover advantage. They are building out their real estate right now, gaining operational experience, while Voyager is still looking at CAD drawings. And regarding the single launch dependency, competitors like Orbital Reef and Vast can launch on existing rockets. If Starship is grounded for a year because of an FAA review or a technical failure, Voyager is stuck on the ground burning cash. Vast can launch on a Falcon 9. Blue Origin can launch on New Glenn. Voyager has backed themselves into a corner by designing a station that only fits on one specific rocket that isn't fully operational yet.
But you have to look at the unit economics. The reason Voyager is targeting a 5-fold return in $8 billion valuation is because the single launch model changes the cost structure. Modular assembly is incredibly capital intensive. Every launch costs money. Every docking adapter adds weight. By launching all at once, Starlab achieves margins that modular stations can't touch. That is how you get to the projected $1.5 billion in free cash flow. If you are building Legos in space, your margins are eaten up by launch costs and assembly labor.
Margins on a spreadsheet are different from margins in reality. And that brings me to the financial sustainability of this infrastructure play. You mentioned the fortress balance sheet, but let's talk about where the money is coming from.
It's coming from the defense and national security segment, which is growing 31% year over year.
Is it sustainable, though, or is it just a sugar high from current geopolitical tensions?
It is absolutely sustainable. Look at the expansion of the American Defense Complex in Pueblo, Colorado, which they broke ground on January 29th. They are verticalizing supply chains for critical programs like the Next Generation Interceptor. This isn't flashy space tourism. This is grinding out tactical munitions and missile defense components. The argument here is simple. The terrestrial defense work generates the cash flow. It funds the orbital ambitions. This decouples Voyager from the need to constantly go back to Wall Street for dilutive equity raises. They are using Pentagon contracts to fund a space station.
But that creates a conglomerate discount. Investors hate complexity. Voyager is the result of 7 different acquisitions mashed together. Integrating the culture and technology across that many firms is a managerial nightmare. And look at the margins. The defense backlog is growing, expected to hit $200 million, but terrestrial manufacturing margins are significantly lower than software or space data margins. If Voyager becomes just another defense subcontractor making missile parts in Colorado, the tech multiple on the stock evaporates. You don't pay 10 times sales for a munitions manufacturer, you pay 1 or 2 times.
That is a risk, I admit, but the market is undervaluing the synergy. Even conservative discounted cash flow models, assuming they just execute on what they have, are suggesting a fair value near $45. That is 70% upside from where we are today at $26. And it's not just me saying this. Look at the institutional signals. Janus Henderson took a position in January 2026. Jonathan Coleman, managing their small cap growth portfolio, explicitly stated Starlab has the best design and lowest cost profile. That is institutional validation. Smart money is starting to treat this as an industrial play, not a venture bet.
Institutions get it wrong all the time, and I want to circle back to the technical moat and specifically this data center narrative, because this is where the bull case gets shaky on the science.
Because of the cooling?
Because of the thermodynamics, yes. The market spiked on February 6th because the CEO mentioned orbital AI processing. The pitch is space data centers. But let's apply some high school physics here. On Earth, data centers use massive amounts of water and air to cool the chips. We use convection, air moves over the hot part and carries the heat away. In space, you are in a vacuum. There is no air. A vacuum is a perfect thermos. It keeps heat in.
Sure, but you have radiative cooling.
Radiative cooling is incredibly inefficient compared to convection. To run industrial levels of power, we're talking NVIDIA H100s or their successors, you generate kilowatts of heat. To get rid of that heat in space, you need massive radiator panels, giant wings of metal to radiate infrared energy. That adds mass. Mass costs money to launch. If they can't solve the cooling problem efficiently, the total addressable market shrinks. It goes from cloud computing in space to just an expensive astronaut hotel. And an astronaut hotel does not justify an $8 billion valuation.
I think you are underestimating the material science innovation here. But even if we discount the data center aspect, you're missing the other side of the manufacturing coin. Things like ZBALN fibers or protein crystals. These are high-value products that require microgravity but don't generate heat, like a GPU does. And remember the patent portfolio. It secures the interface for whatever the payload is. Whether it's a server rack or a petri dish, they still need the Bishop airlock architecture to get power and data. The moat isn't the server. The moat is the plug.
Perhaps. But you're asking investors to pay for a maybe on the physics and a hopefully on the launch vehicle.
I'm asking investors to look at the only company with the cash, the contracts, and the global partners to actually pull it off.
Let's summarize where we stand then. Voyager is undeniably a promising company. I'm not saying it's going to zero, but the current price of $26 reflects a future that hasn't happened yet. The dependency on Starship is a binary risk. It flies or it doesn't. The 84% government concentration makes them vulnerable to a single budget shift in Washington. And that fortress cash pile, in the space industry, $400 million is about 2 years of runway if you hit a snag.
I see it differently. This is a rare chance to buy into a potential monopoly on low Earth orbit infrastructure at a consolidated price. We are sitting at $26, near the bottom of the range. The international partnerships with Japan and Europe provide a geopolitical floor to the stock. These nations need Starlab to succeed to keep their own space programs alive. And the patent portfolio secures the high-margin upside. We are looking at a company that is building the literal port of entry for the next economy.
Well, we won't have to guess for long. The next 24 months are going to reveal everything.
Agreed. Specifically, we need to watch the Starlab Critical Design Review, the CDR.
Explain that for the listeners.
The CDR is the final pencils down moment. It's when the engineering design is frozen and they start cutting metal. If they pass that review without major redesigns, the risk profile changes completely.
In the mid-2026 NASA CLD Phase 2 awards, that is the financial moment of truth. If Voyager secures a major slice of that funding, the thesis holds. If they get cut, or if NASA splits the pot too thinly among competitors, the math gets much, much harder.
Those are the catalysts. The stock is moving on them. It's up to the listener to decide if the risk-reward profile fits their portfolio.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.